When you deposit physical cash into your local bank account, you likely assume that money sits securely inside a vault, waiting for you to withdraw it. In reality, that cash is almost immediately gone. It has been lent out to corporations, home buyers, and credit markets. This is the foundation of a mechanism known as the Fractional Reserve System. Today, we break down the textbook mechanics of how commercial banking networks expand the money supply, effectively creating billions of dollars out of thin air. To understand this system, we must look at the legal reserve requirements set by central banking authorities. By law, commercial banks are not required to hold 100% of your deposits on hand. Instead, they are only mandated to keep a small fraction, often around 10%, as a cash reserve. The remaining 90% is designated as excess reserves, which the bank is legally permitted to utilize to generate profit. If you deposit $10,000, the bank locks $1,000 in reserve and immediately lends the remaining $9,000 to a borrower. Mechanically, the bank hasn't just moved your money. It has credited a new account, introducing $9,000 of brand new purchasing power into the economic landscape. The true magic of the system occurs when that borrowed money is spent. When the first borrower buys a vehicle or invests in a business, the recipient of that capital takes the $9,000 and deposits it into their bank. The second bank applies the exact same fractional rule. It holds $900 in reserve and lends out $8,100 to a new borrower. This cycle repeats continuously across the entire commercial financial network. Through this compounding chain reaction, an initial $10,000 deposit can mathematically expand into $100,000 of circulating credit. This is known as the Money Multiplier Effect. It is the primary engine driving economic liquidity and corporate expansion in the modern world. While this multiplier provides the essential liquidity required to fund modern commerce, it introduces a permanent, structural vulnerability. Because the vast majority of the money supply exists purely as digital credit rather than physical currency, the system relies entirely on public confidence. If every depositor simultaneously demanded their physical cash back, a phenomenon known as a bank run, the institution would face immediate insolvency. This is why central banks act as lenders of last resort, standing ready to provide emergency liquidity to prevent the systemic collapse of the fractional network. The commercial banking system is not a static storage facility. It is an active multiplier of global capital. By understanding fractional reserves, you gain a deeper perspective on how credit governs our everyday lives. Thank you for tuning into this educational briefing from the Fiscal Anchor. Ensure you are subscribed to our timeline so you never miss a structural breakdown. I am David, and I will see you in our next session.